So what actually happens when, major governments, huge global financial players, even sort of prominent political figures, all suddenly decide to pile into the same kind of chaotic new financial space?
It's a big question. Right?
Exactly. And that's what we're diving into today. Welcome to the deep dive. Our focus, stablecoins.
Stablecoins. Definitely a hot topic.
You've absolutely heard the term. But lately, in the past year or so, there's been this incredible rush of activity around regulating them.
Yeah, it's everywhere.
We've got a key U.S. stablecoin bill just moving through the Senate. Then you have Hong Kong, the EU, Singapore, the UK, South Korea, all putting out their own rules.
Even China's central bank talking about them publicly for the first time. That was interesting.
But it's not just governments. Look at Circle Major Issuer, right? Their stock jumped, 750% after listing?
Incredible numbers.
And you've got Stripe, JP Morgan, Goldman Sachs getting involved, plus giants like JD, Ant Group, Xiaomi.
The big players are definitely paying attention.
Now, I know what some of you might be thinking, oh, another crypto thing. Is this just a gimmick?
That's a fair question, given the history.
But really, if it was just a scam, why would all these serious, established players, governments included, be throwing their weight behind it? It makes you pause, doesn't it?
It certainly does. You have to ask why.
So our mission today is basically to cut through the noise, give you the essentials on this really fast-moving space, and, explore if stablecoins really are the future of finance.
Let's unpack it.
Okay, let's start right at the beginning. Fundamentally, what are stablecoins? How are they like, say, Bitcoin, but also crucially different?
Right. So first off, they are cryptocurrencies. They're built on blockchain, same tech.
Okay.
But the key difference, like the name says, is stability. They're designed not to be volatile.
Unlike Bitcoin.
Exactly. The vast majority are pegged usually 1-to-1 to the US dollar. And importantly, these aren't issued by governments or central banks.
Private companies.
Private companies, yeah. Like Tether with USDT, Circle with USDC, those are the big ones.
So how do they keep it stable, that 1-to-1 peg?
It's actually a pretty neat mechanism. It's called unlimited supply and redemption. Basically, you can go to the issuer, give them $1, and get one stablecoin.
Okay.
And critically, you can always go back to them, give them the stablecoin, and get your dollar back.
So that anchors the price.
Precisely. Even if market demand goes up or down, that redemption promise keeps the price right around $1. You can sort of think of it like the old US dollar backed by gold.
Okay, I get that analogy.
Stablecoins are backed by actual US dollar reserves. So if you look at Tether's reports, for instance, they show they hold billions more in reserves than the USDT they've issued. There's a surplus.
So there's real money behind them.
Mostly, yes. Yeah. Now, there are other types like decentralized ones or algorithmic ones, but they're a much smaller slice of the pie.
Right.
USDT from Tether is dominant, maybe 60% of the market. And USDC is next, around 24%.
Got it.
What's kind of ironic, though, is that blockchain is all about decentralization, right? But the main stablecoin model everyone uses, it's actually centralized, relies entirely on that one company issuing it.
Huh. That is interesting. Okay, but let's switch gears a bit.
Yeah.
This might sound weird, but if they're just doing this 1-to-1 peg, how on earth are they making so much money? We're talking billions in profit.
Right. That's the billion-dollar question.
Yeah.
The key insight is that these issuers are essentially running super lean, super profitable money market funds.
Okay, explain that.
So when you buy, say, $100 of USDC from Circle, they take your actual $100 and they invest it. They put that pool of reserve dollars into really safe, really liquid things. Think short-term U.S. Treasury bonds, overnight bank loans, stuff like that.
So they earn interest on the reserves.
Exactly. And with interest rates where they've been, those returns are substantial. Take Tether again, they've got, $150 billion issued?
Yeah.
Even earning a pretty conservative 4% on that, you're looking at $6 billion a year in interest income.
Wow.
Profit.
Wow. Just from interest.
Pretty much. And they do it with tiny teams. Tether apparently made $13 billion last year with just over 100 people.
That profit per employee is staggering.
It really is. Now, Circle has a slightly different angle, too. They work really closely with crypto exchanges.
How so?
Well, in 2024, they reported like $1.68 billion in interest income, but over $1 billion of that got shared with the exchanges.
Why would they do that?
The exchanges use that money for subsidies, promotions, rewards, basically to get users like you and me to hold and use USDC on their platforms. It's kind of like a credit card reward cycle driving adoption.
That makes sense. Creating an incentive loop. Okay, so this profitability and the stability, It starts to explain the appeal. But let's get into the really interesting part. Why are stablecoins suddenly seen as so critical? Why now?
Yeah, the timing is key. I think it boils down to their core advantages hitting a critical mass. They're convenient, they offer privacy, and crucially, they're stable.
Addressing that big crypto problem.
Exactly. That stability opens up real-world uses. Now, we have to acknowledge that privacy and stability makes them useful for illicit activities too, black markets.
Right. That's always a concern with crypto.
It is, but the legitimate use cases are exploding. Cross-border payments is probably the biggest one right now.
Why is it so much better than, say, a bank wire?
Think about sending money internationally with a bank, especially smaller currencies. You're paying maybe 5% or more in fees. It can take days.
Yeah, it's slow and
With
expensive.
stablecoins,
Yeah.
because it's on the blockchain, there are basically no cross-border fees, no currency conversion hassle if you're using a dollar-pegged coin. It arrives in minutes, and the transaction costs are tiny.
Okay, that's a huge difference.
It's massive. The global cross-border payment market is something like $200 trillion a year.
Wow.
And stablecoins in this space went from almost nothing 18 months ago to around $50 billion per month now.
Per month.
Yeah, growing like 20–30% monthly. It's astonishing growth. And that's why you see giants like Amazon, Walmart, JD.com looking very closely at this. They move huge amounts of money across borders.
Okay, cross-border payments. What else?
Another huge area is in countries with high inflation or strict currency controls. Think Argentina, Nigeria, Brazil, Turkey.
Places where the local currency isn't stable?
Exactly. Since 2020 especially, their currencies have often tanked, and getting foreign currency like US dollars is hard. So people there are using stablecoins as a kind of digital US dollar.
For savings.
Huh?
Or daily use.
Both. To protect their savings from inflation and increasingly for everyday transactions. What's fascinating is how governments reacted.
They tried to ban it.
Initially, yeah, they were prohibitive, but the public demand was just overwhelming, so many have done a complete 180.
Really?
Yeah. Brazil, for example, is integrating stablecoins into PIX, their official instant payment system. Argentina has basically legalized using them. They realized if people are going to use them anyway, better to bring it into the light and regulate it.
Fascinating. Adapt or get left behind?
Pretty much. And just look at the scale now. The total value of stablecoins is over $250 billion. That's up 20 times in 5 years.
Huge growth.
But here's the really eye-popping stat. Their transaction volume, the amount actually moving around, hit $27.6 trillion in 2024.
Wait, 27 trillion?
Trillion. That actually surpassed the combined payment volume of Visa and MasterCard.
Okay, that puts it in perspective. That's not niche anymore.
Not at all. It shows they have a really strong monetary attribute, as economists might say. They're being used like money on a massive scale.
Which, of course, brings us to the risks. Speculation, money laundering, the stuff regulators worry about. So given everything we've discussed, the growth, the potential, why the global rush to legislate now?
That's a really important point. The lack of clear rules before was actually a big problem. It held back legitimate companies and, frankly, let the shadier actors flourish.
Made it the Wild West.
Kind of, yeah. So this new wave of legislation, even if it's strict, is seen by many in the industry as a necessary reboot. It brings clarity, legitimacy.
So who's leading the charge? The U.S. seems pretty active.
The U.S. is definitely a major driver. It's interesting. Under the Trump administration, there was this executive order to boost U.S. leadership in digital finance, but specifically not a central bank digital dollar.
Right.
And you also saw private initiatives take off, like that USDE stablecoin backed by Abu Dhabi's sovereign wealth fund, which grew super fast.
Okay, and the legislation now, what's in it?
Well, there's a key bill moving through the Senate. And what you see in the U.S. proposals, and mirrored in many other countries too, are things like strict licensing for issuers.
Makes sense.
A requirement for 100% backing with high-quality liquid assets, mostly short-term treasuries, cash, overnight repos.
Like we talked about.
Crucially, they can't rehypothecate those assets, meaning the issuer can't lend them out or use them for their own bets.
So the reserves are ring-fenced.
Exactly. And stablecoin holders get paid out first if the issuer goes bust. Plus, strong rules on risk management, transparency, anti-money laundering, often even stricter than rules for banks.
Wow. So compliance becomes key.
Absolutely vital. Look at Tether, huge market share, but they face hurdles in the US because regulators feel they haven't disclosed enough, aren't fully registered there.
Right.
Contrast that with, say, OKX, a major exchange. They proactively settled with the US government, paid big fines, even shut down certain wallet features prone to misuse.
Trying to get ahead of it.
Yeah, and that helps them get licenses in places like the US, Europe, Singapore, Dubai. They publish monthly proof of reserves too. And for companies like Coinbase or Circle, listing on the US stock market,
That's like the ultimate stamp of approval.
it's seen as the most powerful compliance statement, yeah. Builds massive trust with users, partners, regulators.
Okay, so the U.S. wants clear rules.
Yeah.
What's the bigger strategic play for Washington? Why this push?
Well, beyond just needing clear rules, there are definitely bigger goals. First, and probably foremost, is maintaining the US dollar's dominance globally.
How do stablecoins help that?
If the world starts using USD-pegged stablecoins for everything, especially cross-border trade, well, that just expands the dollar's reach and influence. It could even accelerate dollarization in countries with weak currencies.
Spreading the dollar digitally.
Essentially, yes. Second, it boosts demand for U.S. government debt.
Because of the reserves.
Exactly. Those reserves, mostly short-term treasuries, mean stablecoin issuers become huge buyers of U.S. debt. Tether bought over $33 billion in treasuries in 2024 alone, making them like the 7th biggest buyer globally.
That's significant.
The Treasury Secretary even projected stablecoins could drive over $1 trillion in demand for short-term treasuries by 2028. Now,
There's a but.
well, just a nuance. Some argue this might not be the main driver because these are mostly ultra-short-term bills under 3 months. Their interest rates are really set by the Fed, not market demand like long-term bonds that big countries buy. But it definitely doesn't hurt U.S. finances.
Okay. Any other U.S. goals?
Finally, it's about competing on the new crypto frontier. The U.S. realized it probably can't just suppress crypto.
Right.
So the thinking is, if you can't beat them, regulate them, embrace the parts that strengthen your position, like USD stablecoins, and compete hard so you don't lose your global financial leadership in this new arena. Because other places, Europe, Singapore, Hong Kong, the Middle East, Switzerland, they actually moved earlier on this.
So the U.S. is playing catch-up in some ways. What about those other players?
Yeah.
China, for instance. They banned crypto mainland, right?
They did, and they're pushing their own digital yuan. But their strategy seems to be using Hong Kong as a sort of test lab for stablecoins.
Interesting. For what kind?
Specifically, HK dollar and offshore UN stablecoins. Hong Kong's running a sandbox now. Just licensed the first batch JD's blockchain arm, an insurance tech firm, a group including Standard Chartered. Ant Group is apparently keen to get in next.
And the goal there.
Cross-border payments seems key. Linking mainland China and Hong Kong for smoother fund flows, potentially using UN stablecoins to internationalize the RMB more easily.
Makes sense. And Europe, you mentioned that.
Europe's MiCA regulation, passed in 2023, is seen as very cautious.
How so?
They put in strict limits. No fees on basic stablecoin use, no paying interest on stablecoin balances, and tight caps on daily transaction volumes.
Why so restrictive?
The idea is to protect financial stability, existing payment systems, and their own monetary control. Basically, they want stablecoins for payments, but they don't want them competing with bank deposits or becoming major investment tools in Europe.
Okay, much more walled garden approach.
Yeah.
What about places like Singapore or the UAE?
They're kind of the opposite, actively open. They want to be global crypto hubs. Singapore put out rules early in 2023. The UAE is very permissive, low taxes. Basically, if it's not forbidden, it's allowed.
Attracting the industry.
Exactly. And South Korea is interesting, too. They were cautious, especially after the big Luna stablecoin crash.
Oh, yeah. That was huge.
But the new president is more pro-crypto, supports developing a Korean won stablecoin. So you can kind of group countries, actively open, cautious, but trying to include it, and then strictly restrictive.
It really is a global patchwork.
Yeah.
But stepping back, this isn't just about stablecoins as currency replacements, is it? It feels like part of a bigger trend, something called tokenization.
Absolutely. That's a great way to frame it. Stablecoins fit right into this broader concept of tokenization and real-world assets, or RWA.
Okay, what does that mean, RWA?
Basically, it's taking assets from the real world, think real estate, company bonds, even art or intellectual property, and creating a digital representation, a token, for them on a blockchain.
And why do that?
It makes them potentially easier to trade, more transparent. You can divide ownership easily, lots of potential benefits. And stablecoins themselves, they're a perfect example of RWA. They're tokenized US dollars.
Oh, okay. Tokenized cash.
Exactly. And look at BlackRock, the world's biggest asset manager. They launched a fund called BUIDL in March 2024.
BUIDL.
Yeah, it's a tokenized US dollar money market fund running on a blockchain. That's a massive signal from traditional finance. They're not just watching anymore, they're participating.
BlackRock doing on-chain funds. Wow.
And it's already managing billions. You also see Ant Group in Hong Kong experimenting with tokenizing things like electric vehicle charging stations or solar farms to raise money via blockchain. Hong Kong and Singapore are really pushing RWA.
So the infrastructure is building out.
Definitely. And stablecoin payment systems are evolving fast too. Like OKX Pay, you can use QR codes to send stablecoins, kind of like Alipay or WeChat Pay, manage your balance like an online fund.
Yeah.
But it's all crypto underneath.
And mainstream players are joining in.
Big time. PayPal, Stripe, they're integrating stablecoin payments into their existing platforms.
Which brings us back to that idea. If you can't beat them, join them.
That dynamic is crystal clear now. Banks, payment firms, even governments. Many were skeptical or hostile at first.
Yeah.
But they've realized this isn't going away. So now many are not just joining, some are trying to lead the charge. The best example is JP Morgan.
Right, you mentioned them.
Their CEO famously called Bitcoin a fraud just a few years back now. They have their own blockchain-based deposit token, JPM coin, used for internal settlements.
Quite the turnaround.
It really is. So you have all these different players with different motives. The U.S. wants dollar power. Other countries want a strategic edge. Individuals might see opportunity. Companies want profit. But all these actions pulling in different directions sometimes are collectively pushing the whole stablecoin and crypto market forward. And honestly, even the regulators and governments are probably figuring this out step by step. It's too complex for anyone to have a perfect master plan.
Just reacting and adapting as they go. That JP Morgan story really sums up the shift. Okay, so if this trend continues, stablecoins grow, tokenization expands, what does it actually mean for the traditional banks, the central banks, the system we're used to?
Yeah, the downstream effects are potentially huge. The core concept here is financial disintermediation.
Meaning cutting out the middleman.
Exactly. Stablecoins and the broader world of DeFi allow people and businesses to do financial things directly, bypassing traditional intermediaries like banks or payment processors.
And that's bad for banks.
It presents two main worries for them. First, potential loss of business, profit, and just general flexibility. If money that used to sit in bank deposits now sits in stablecoin reserves.
Even if the reserves end up back in banks somewhere.
Right, the banks lose that direct customer relationship, the ability to easily lend that money out multiple times, the fees. It could shrink their role in profits.
Okay, that's one concern. What's the second?
The second is a big one for central banks. Weaken control over monetary policy. If a large chunk of the economy's money supply and transactions are happening outside the traditional banking system they regulate and influence, it gets much harder for them to steer the economy using their usual tools, like interest rates targeting bank lending.
Right. Their livers don't work as well.
Exactly. And this leads to a really critical, still unanswered question. In this potential crypto-based financial system, who actually controls monetary policy? How do you manage the supply and flow of stablecoins on a macro level?
That's a huge question. Is anyone answering it?
Honestly, regulators are mostly kind of sidestepping it for now.
How?
By primarily defining stablecoins legally as payment instruments or e-money, not as deposits or investments. That's why you see rules in the US and EU explicitly prohibiting stablecoins from paying interest or heavily restricting it.
So they don't compete directly with bank savings accounts.
Precisely. They want to keep stablecoins focused on just making payments for now, discouraging people from holding large amounts long-term as savings. It's a way to contain the potential disruption to the banking system and monetary policy, at least for the time being.
A temporary fix, maybe?
Yeah.
This whole deep dive really shows just how complex stablecoins are.
Yeah.
They're not simple at all. It feels like they're at the center of multiple clashes, right?
Absolutely. Clashes between nations and their currencies, traditional finance versus crypto, private companies versus government regulation.
And even just the fundamental tension between wanting stability and driving innovation.
Well put. It's genuinely fascinating and frankly exciting to see this global embrace, even with all the risks. It's pushing boundaries in ways we couldn't have imagined just a few years ago.
So maybe the thought to leave everyone with is,
Yeah, perhaps it's this. If this is the direction things are heading, what form will this whole Web3 world ultimately take? How will it really disrupt and transform the financial system we know?
A massive question, and one that will definitely keep us thinking. We really encourage you to keep exploring these developments yourself. Thanks so much for joining us on this deep dive.